Hello and welcome to Beyond GDP, the Social Progress Podcast, where we're talking about how to remake our economic, social, and political systems to better serve people and planet. I'm Michael Green, CEO of the Social Progress Imperative, and today we're going to be talking about the role of business. Now, the Global Social Progress Index shows that progress towards Sustainable Development Goals really stalled after COVID, even though the global economy rebounded. Governments are broke, the international system is fraying. So what should business do to get the world back on track to achieve the SDGs? To discuss this, I'm joined by Catherine Howarth, CEO of the NGO ShareAction, who has a remarkable track record working with businesses and investors to advance sustainable and inclusive practices. Catherine, welcome.
Thank you. Wonderful to be here.
Great to have you with us. Now, let's start with the basics first of all. You know, the business of business is business. Milton Friedman, the duty of businesses is to serve shareholders. Why is it business's job to tackle environmental and social problems?
The reason it's business's job to do that is that businesses are owned, particularly big businesses. For example, big businesses listed on stock exchanges across the world. They're owned by institutional investors, also individual retail investors, but to a large extent in the 21st century, they're owned by institutional investors. And what we're talking about is sovereign wealth funds and particularly pension funds. So that money and that ownership is all of our business. And as people who save into a pension scheme and end up owning shares in the largest companies, we have this dual interest in those companies performing well from a commercial and investment returns point of view, because that's how we will be able to retire in some degree of security and comfort in our old age. But we have a very direct interest in the behavior of those companies, because it shapes the communities that we live in, the organizations we're employed by, the food we eat, the air we breathe. We're the owners of the companies. And so it's right that they should be behaving in ways that serve our broader interests. And Milton Friedman's view, that narrow returns maximizing view, can make sense if you own just one particular company. But when you, as large investors do, own a huge range of companies across the economy, you actually really need them to behave in a sort of pro-social, pro-environmental way, partly because they're owned, as I say, by millions of ordinary people who have an interest in corporate behavior, but also because companies that export harms and problems onto other companies end up actually limiting the returns of those other companies as well. So there's this very important need to recognize that in the 21st century, the nature of capital markets and investment markets and large investors owning companies creates a very different mandate, one that absolutely requires companies to consider their social and environmental impacts because their owners have an interest in that.
So I could be like an ethical consumer in what I buy, etc. But then the money in my pension could be driving companies to, invest in fossil fuels, deforest the Amazon, treat workers poorly. And that's the sort of paradox we can have, that we can be ethical on the consumer side, but our pension could be doing a lot of harm. And that's why you're focused on the pension industry itself.
Well, it's one of the reasons. And then we're also interested in the pensions fund industry because in a world of shareholder primacy, in a world where companies' legal duties are basically pointed at their shareholders, it's shareholders that can really drive behavior change in the corporate sector. So, whilst you can have sort of NGOs and consumer interest groups nudging and nibbling away and raising issues in newspapers, etc., companies really are scared by, if you like, or can be really influenced by their owners, their investors, who, for example, have extremely important rights to elect the boards of directors of companies. And that's why we work with the investment community, because that's the community that actually has real leverage, along with, of course, the policy makers that create the legal environment in which companies operate. But those two levers are both need to be pulled. We need appropriate public policies that manage and restrict companies from creating harms. And we also need shareholders and investors in those companies that make the same case. And it's when you can align all of that that you really do see actual movement in corporate behaviour. And I'm pleased to say that over the years at ShareAction, we've proved that mobilising large investors to talk to companies about their social and environmental impacts and performance can be very impactful.
Because people sort of think of activism as being about throwing orange paint over artworks or blocking motorways, but you've really used this sort of shareholder power. Let's look at a kind of a practical area. I mean, the big one that we can't avoid, the climate emergency. What have you been doing on the climate crisis?
Well, we're failing on the climate crisis collectively. That's unfortunately the first thing to point out. But I should also say that companies that are helping to solve the climate crisis with their innovative green solutions and clean energy solutions are perfectly capable of making really good money for investors. But there's not enough of the investment community that's really focused on taking the tougher short-term decisions to dial down capital allocation to polluting, carbon destructive, climate destructive companies. And so, I mean, a good example would be the banking sector. We've worked for years at ShareAction to rank the climate performance of banks, which banks are lending to the fossil fuel economy and helping the continued expansion of fossil fuel operations, and which banks are actually developing tough policies that restrict financing and allocate a much more generous slug of bank lending and also from the insurance side, underwriting to the opportunity set around the green transition. So we have done a lot of work on the banking sector and actually very challenged at the minute, I will say, by the fact that we saw a lot of commitments in the global banking community around this. And we've seen a retreat, sadly. In fact, this morning, HSBC, one of the world's largest banks, the largest in Europe, major trading bank, financing a lot of global trade, they've released new documentation today, which are unfortunately really disappointing in terms of their continued commitment. Now, what's important to remember is that alongside all the customers of HSBC, which includes millions and millions of retail customers who have a bank account, a savings account, or their salary gets paid into an HSBC bank account, and also corporate clients, HSBC has a load of major shareholders who are our pension funds. So we can definitely put the heat on, not just HSBC, but others who backslide in this area, because it is so critical that the world's largest banks are held to account for the contribution they need to make and for their problematic contribution to ongoing climate damage.
It's fascinating you've seen that there's a point in the system where you can exert pressure through the banks rather than just going after the oil companies themselves. You're also looking at sort of health issues as well, and companies' performance on health and I think fair pay as well.
Yeah, absolutely. So we talk a bit about a climate emergency or planetary health being something that really matters, but people's health is a crucial underpinner or an underpin for a shared prosperity beyond GDP, positive society and economy, and it gets very neglected. So we're all familiar with thinking about the big fossil fuel companies you mentioned a minute ago, the oil and gas majors, etc. But think of the Unilever, Nestle's, Mondelez, the companies who profit from selling a huge amount of sugary junk and ultra-processed food. Again, all these firms are in our pension funds, and we are mobilizing major investors to say, well, people save towards a retirement, hoping to be healthy in their old age. If their pension fund was invested in companies that were undermining their health on their way to retirement, it's sort of kind of a bad deal. So let's bring that shareholder power that's held in our pension funds to bring it to bear on companies, not just in the food space, but let's say thinking about issues like antibiotic resistance, thinking about issues like air pollution, thinking about issues like mental health in the workplace. These are all areas in which public health is influenced by the corporate community and where there is great scope. And we're proving that there's real potential to bring investor pressure to bear in ways that strengthens the health impact of these major companies. And yeah, absolutely, fair wages, real living wages is another really big focus of ours. So again, would you want to be invested in companies that don't pay their own workforce enough to survive, let alone pay into a pension? And the answer to that amongst the population at large is no. There is incredibly strong support for pension funds acting as responsible stewards of the companies in their portfolios when it comes to questions of decent work and fair wages. People don't want to profit more in their pension fund at the expense of other working people who aren't, paid a living wage because there's dividends being paid to shareholders ahead of that. And so one of the things we've proved with the work, or shown with the work, is that those underlying pension savers really want to see their pension funds being ambitious in promoting a fair wage economy. And that's not happening as much as it could. Now, we've made some really good progress, but I would say there's a democratic gap between what people want their pension fund to do and how that power that's held on their behalf by these massive pension fund organizations is actually used in terms of the nudges and the communication and the dialogue to the companies in the portfolio. So a lot of our work is actually about highlighting that gap between what people would like seeing done with their pension fund assets and what actually happens in the financial markets in practice.
And a lot of these things aren't about being ethical or being nice. They're actually sound investments. Our chief advisor has been Professor Michael Porter from Harvard Business School. And he always made this point that, his experience as a, red in tooth and claw business professor was that economic success was built on strong social foundations. And we know that there's a huge productivity crisis, certainly in the UK economy and many advanced economies, because of mental health, lost sick days because of terrible food. So actually fixing those systems is actually investment in productivity that's good for the economy as a whole. So it's not just about being ethical and moral, it's actually about self-interest.
Oh, absolutely. And I think that's really important to emphasise. So just this week in the UK, Sir Charlie Mayfield, who was the chair of one of the major companies in the UK, has completed and published a major piece of work for the government looking at how do we make sure more people across our economy are included within the workforce and not off sick. And he's making a strong economic argument for that. He's saying, look, we all prosper economically when people are fit to go to work. And there's an incredibly important role for companies in protecting people's health. And there's a fund manager working on this called CCLA, who's done some really good analysis showing that for every £1 invested in the mental health of the workforce, there's a fivefold return on investment. So at the workplace level, but also across the economy, there's a very, very strong economic case and business rationale for much of the agenda that's pursued by ShareAction and the growing number of responsible investors across the economy that are engaged with these themes.
Now, this is all well and good, but you're based in the UK, your work is focused on the UK and Europe, and across the pond there is the Donald. And there's been a very big turn against this kind of thinking in the investment business. And it does seem, as far as I can see, big fund managers in the US have scuttled away from social environmental responsibility in response to what's come out of the White House. I mean, how bad is it in terms of the global sentiment on this, and particularly where US fund managers are behaving?
Yeah, been a real backward step in the US. I'll say more about that in a second. But I just want to highlight that in most other regions of the world, this continues to be a very strong agenda. We haven't seen a collapse overall in Europe. There's a little bit of bit less sort of on an accelerated timetable time than maybe a couple of years ago, but still very much holding up. And in Asia, I think this is very much a growth area. South America also. So let's talk about the US for a minute, because it does really count. The largest fund managers in the world are all American. They have the largest sort of liquid capital markets. They have many of the largest companies. And what happens there has outsized influence. And it's very concerning to see that we've seen this kind of highly politicized development in what should be just a very neutral focus, first on business relevant action, that to go back to the issue we talked about a minute ago, like public health and workforce health. There's a really strong business rationale. So why on earth would you would really be neglecting your obligations as an institutional investor to manage financial risk if you don't take account of these issues. So that's an issue. But moreover, it's other people's money. And even in the US, there's strong underlying support in the population. And I've seen some stats just the other day about retail investors in Vanguard, which is the world's second largest fund manager after BlackRock. People under 45 remain completely interested in making sure that their retirement assets are invested with environmental and social considerations, a high focus area. So I'm ultimately quite I'm disappointed by the turn of events over in the recent past, but I'm ultimately very confident that the public mandate for this, and also the sheer business rationale for this, will help reverse the problem that we've seen in the last couple of years, the so-called ESG backlash. But that does bring me to this question of accountability of institutional investors to their underlying clients and the beneficiaries, let's say the members of pension schemes, because there is a democracy issue in this zone, and the people that look after other people's money are not accountable. So if you buy shares in an individual company, you can go to that company's AGM, you can elect the directors or vote against them. You've got certain historic rights that actually create a bit of accountability and actually some democratic structures there in the heart of capitalism. But in the institutional investment world, where people could have their whole lifetime's retirement savings in one institution, there are vanishingly few that run an AGM that allow the trustees to be elected and removed. That allow members to put forward a motion or propose something. These rights, which exist in the corporate community but don't exist in the investment community, is an issue. And that's one of the reasons I think that you can see this big disconnect between what investors do and what their underlying clients and the members of these pension schemes would actually like to see them do. And closing that gap is a big focus area for us as an organisation.
Well, that's fascinating. So there's actually an accountability issue here that's at the root of the problem. Now, look, we're almost out of time, but no one gets away from the Beyond GDP podcast without giving us a prediction. Catherine, look into the crystal ball. Give us a prediction. A year ahead, 10 years ahead, next week, it doesn't matter. Give us a prediction.
So my prediction is that we are going to see slowly demand for democratic rights inside the capitalist system. That we, if you think back to the 19th century and much of the 20th century, we saw big struggles for people to have their voice within the political realm. And the fact is that our lives are shaped by the political realm and by the business and corporate realm. And we lack rights and voice and voting opportunities over there in the corporate community and in the investment system. And that's what I predict will change in the coming decades.
Fantastic. Catherine Howarth, thank you so much for joining us. It's been fantastic talking to you, and let's hope that your prediction comes true.
Thank you.